Thanks for joining us today. Welcome to Market Matters. For those of you that are new joining us this time, this is our monthly webcast series, trying to bring you some more insights into what we're doing in portfolios. And I think you'll see in today's presentation, we've got a number of things that we'll be talking about relating to changes in activity. So I think we'll enjoy it. Just as a kind of run of show here, this is the agenda we'll cover loosely. We're going to talk about COVID-19 and the updates on that front, some economic and investment updates relating to portfolio changes, and then also I think the special topic, given our epidemiologist had to reschedule for another engagement, I thought speaking about what's going on with GameStop, AMC, which is a movie theater company, and what those situations are really involved in entail, it would be useful to touch on, particularly as it relates to risk management, which, as you know, is a key part of our process. Just by way of reference, if you do have any questions at any point throughout the presentation, please feel free to drop those questions into the chat feature of Zoom. I'll pick those off the chat function and try to address those as we move along through the presentation, hopefully touching on it with some content. And just to give you an idea of how long these usually last, I'm targeting somewhere in the neighborhood of 30 to 35 minutes, depending on how many questions we receive over the course of the presentation. But I'm certainly happy to stick around as long as I need to answer questions as if there are any. So with that, let's get started and take a look at what's going on with COVID-19. So here's the updated pipeline. Again, this comes directly from the New York Times vaccine tracker. This was data was as of yesterday. This is a real-time view of what's going on within that pipeline of activity. And you can see, I think, what's really encouraging here are a couple of things. One is the number of vaccines approved for limited use has increased since the last time, I think by about 3, since the last time we had Market Matters in January. And full approved usage in the US is up to 2. I don't think that's really changed much since January. And then there's been a few abandoned trials, most recently with Merck. So I think certainly a lot. And then of course, phase 1, 2, and 3 trials are all great developments, because the more potential vaccines we have to address the COVID-19 situation, the better, because not everyone's interaction and experience will likely be the same. And some people have different conditions that require a different approach. So I think to net it out from this slide, the pipeline is very full. We're starting to get a expansion and acceleration of approvals, and that's a good thing in my book. Looking at pivoting to the next most critical question, now that we have vaccines approved, how are they getting distributed throughout the population? Because obviously we don't have necessarily a national approach to this yet, which I think is a big mistake. We're leaving it to the states. So what you see on the screen in front of you is the number of doses per day in the green line, in the green bar. So just for reference, this is the 1st of December. And over here is the number of doses per day, 500,000, 1 million, 1.5 million, 2. We haven't got to the 2 level yet, but that's something that President Biden is really keen on achieving here very rapidly. But I would say on average, it's been a better than expected distribution, even though it's been a little chaotic at first, because the number of doses receiving per day is averaging about 1.3 million. So higher than the million that I think initially a lot of the media had targeted, and below the $2 million mark, but we're getting there. There's a template though for getting to a level that I think would be acceptable, or would be really great to get to, and that is what's going on within Israel right now. Because you can see on the screen in front of you, this is a global look at how distribution is going. US is down here. We're still really kind of trying to coordinate our efforts nationally and ramp up appropriately. And I think Israel's program, you've probably read about it in various outlets, but it's a template, I think, as to where we can get to in a very quick succession. And I think if early indications are any guide, Israel's been so successful, they've gotten more than half of their population vaccinated already. And that's leading to a substantial decline, not only in hospitalization rates as it relates to COVID, but also number of cases. And that's certainly something that would be very valuable to get us to a quicker reopening in the economy, which would, of course, pull forward economic activity, which is good. That's the quicker we can open up, the better. And that certainly formulates a thesis of, I think, some growth expectations that a lot of folks have at different investment firms for 2021. So let's take a look and pivot here at some of the economic and investment updates that we've had for the month of January. As I reiterated last time, our most recent investment committee decision has been to downgrade the role of fixed income or bonds in our portfolios from a neutral rating to a more or less a somewhat attractive viewpoint in favor of things like alternative assets, things like liquid alt income funds and things of that nature, and also a modest upgrade in the mid-cap space from less attractive to neutral. Really under the idea that if we are going to see a more rapid recovery, then accompanying inflation shouldn't be that far behind, and that's going to be a hamper to bond prices rising, yields rising, bond prices falling. So we're just updating our views accordingly based on what we're seeing here over the intermediate term. And generally speaking, some portfolio notes I wanted to touch on before we get into the meat of the presentation is that we are actually now in a period where there is some rebalancing activity going on. It's not going to be uniform across the board. It's actually going to be fairly targeted, but there are some strategies that we've had in place for a number of months or even years that have done quite well coming into 2021. And we are looking to trim back some of those positions in favor of adding to things like fixed income or more appropriately alternative positions that are income generating. This volatility that we've seen recently has given us the opportunity to start this effort. So, I think that we are taking advantage of some of the volatility that the market is presenting us and likely will for the foreseeable future. Continuing to hold, strategies that worked in 2020, we think that some of the disruptive technologies and technology companies that worked so well in 2020 will likely have a fairly decent runway in 21 as well. I did also want to note that portfolio turnover is increasing. So that means we're changing out positions a little more quickly than we have in the past. And I think there's good reasons to do that. The primary reason you do that, of course, is that in the case of a single stock, you've met your price target on the upside. So that's usually a good reason to have portfolio turnover. And then I just wanted to note here on the equity side, actively managed strategies continue to present a pretty compelling risk reward to the upside. Index investing right now, to some of your questions or comments that I've been talking to you recently about, really doesn't have a very good forward-looking return profile to it. Fixed income, there has been a decent uptick in yields from about 50 basis points, call it in Q3 of last year to now. Here we are at 1.1 on the US 10-year. It's a pretty decent move. Our active fixed income strategies are actually holding up really well, particularly from the start of the year, where you've got about a 80 basis point loss in fixed income indexes, and our fixed income portfolios are basically flat for the year, which in my book, that's a pretty nice win. And we continue to add to shorter duration positions and higher quality positions so they can fulfill that capital preservation function that we have identified is important for fixed income. On the alternative side, this is taking a little bit larger role in portfolios, as I mentioned, because there are some positions that are not necessarily explicitly fixed income that do generate yield that we think has a wider application. And particularly from starting yield standpoint, it just is much more attractive than traditional treasury bonds or even corporate bonds for that matter. So let's get into some of the economic data. And in January, we've seen some pretty remarkable economic data that is, as seen in the screen in front of you. Recall that in January, for the December reading of the Case-Shiller Home Price Index, homes were up roughly 6 or 7% in price. Well, that strength in the single-family home market has only gotten stronger coming into January. And you can see here what we've got is almost a 10% year-over-year increase in housing. And that is, to accompany that as well, home ownership rates are on the rise as well too. So home ownership had actually gotten down to about 62% coming into 2020. Now it's back up to that more historical average of roughly 66 or 67%. And along with that buying activity and relocation is the idea that home prices continue to move higher. And I think this bodes actually pretty well for urban or rural areas as well as suburban areas. So they're starting to benefit from some of this activity we're seeing in the housing market. But that's a key underpinning to, I think, sustaining a very strong economy into 2021. Key to any asset price, of course, is what's inflation doing, because if inflation is rising, that value of that asset should be worth less. But the good news is, I think, or maybe not so great news, but for us in the intermediate term, inflation does not appear to be a big problem right now. And this is a reading of the Consumer Price Index. I am aware that some people feel this is not a great index to use to measure inflation, but it's I think it's the most widely recognized. So that's why I continue to use it. And what you can see here is the Consumer Price Index, the aggregate index, is only reading at a 1.36%. Recall that the Fed has a explicit target of 2%. That's a green line here. And also recall that the Fed has indicated they're going to let inflation, quote unquote, run a little hot for a few months or as long as it takes to get sustainable inflation above 2%. Why do they want inflation over 2%? That's a great question. It tends to be a big topic for discussion within the economic space. I'm not a big believer of 2% being the magic number, but that's their number. So it's something that we pay attention to. And I guess for equities in particular, or private assets or real estate, the good news is that low inflation means that prices won't be necessarily impacted too much by the rate of inflation we have currently right now. So inflation in check is good. And then take a look at what's going on in the manufacturing sector in the U.S. You can see here, this is a chart showing the manufacturing index, PMI, Purchasing Managers Index, starting in 2014 through today. And you can see when we got this huge dip, of course, COVID related, in middle of 2020, we've now risen from a manufacturing activity standpoint to a level that's higher than any reading on this chart series, even going back now to, I think it's 2009 in that recovery. We're starting to see that level of recovery in the manufacturing sector, which is really good because it means that it's just going to be another strong underpinning for the economy, which will sustain potentially asset prices, but also an improvement in the employment picture. But I know there's some people out there that say it doesn't really seem right, but this is the data that we have. This is a non-governmental data source, so it's privately sourced activity. So looking at the picture so far for stocks this year, I like to just start us from a common reference point. You can see a few things have emerged. Stuck in neutral was the question with a question mark. And I would say for some parts of the markets that has been the case, but for others, the more risk-seeking or riskier parts of the market, like small cap and emerging markets, that has not been the case. So small cap and emerging markets are up about 6 and 7% respectively. U.S. large cap and U.S. or an international large cap are kind of waffling around this break even for 2021 so far. That makes sense if you ask me, particularly if what the term is, reflation or a improving in the global economy is set to take shape. We're not totally convinced that that's going to be sustainable over a long period of time, but in the short period or shorter term, this is makes sense to us. And as you may recall, we added pretty decently to an emerging market position starting in the middle of early last year, and that's worked out pretty well for us so far. And what's driving some of the growth in the S&P, or what did last year, and I think it's just this methodical improvement of earnings that is getting better than expected at various points over the year last year, and it's even more pronounced. You can see Q4 earnings are now starting to come in, or they have been coming in over the last couple of weeks. And you can see at the end of December, people thought, or the analyst community on average thought, the S&P earnings were going to decline about 9% year over year. What's actually happened is that the S&P earnings have declined only 2.5% or 2.3%. So this big difference in the expectation is really, I think, what drove a lot of Q4's upside surprise within equities, because if you can surprise to the upside, where do those surprises come from? Well, the biggest one, which is I think very positive and why financials rallied so much, was in this financial sector. The banks, by and large, are all reporting record earnings, not from interest income, but from their trading activities. And that's not a great source of earnings. It's not very super durable over the long term, but it's definitely a source of earnings and one that I think is well received for sure. And also materials. The materials sector is responding to changes in demand, maybe potentially from inflation coming, but also from the manufacturing sector in particular. And that's really been, I think, a nice positive upside surprise. Then, of course, the technology sector, way surprising on the upside, much quicker adoption for a variety of key technologies that is showing up in earnings, particularly in Q4. Fixed income continues to be a little bit of a different animal right now because you can see this is the year-to-date picture of those broad bond indexes that we've been highlighting for the last, call it a year or so. And you can see by and large, well, here's the zero line, and anything below zero is a negative return. So far this year, bonds have had an across-the-board negative return, dependent and not even related to any particular category. What's held up the best, of course, has been the junk bond index. That tends to be the most economically sensitive bond index. And that, kind of makes sense. If we get a better economy, there'll be less defaults within the bond sector. And that kind of makes sense why that's the case so far. But you can see here, US high quality bonds. This is the aggregate bond index, down 80 basis points. And really, what's that being driven by? It's being driven by yields rising. So again, over this time period, yields in the 10-year have risen somewhere in the neighborhood of from 75 basis points at I think it's the end of Q4 to where we are now, which is 1.1 on the 10-year. So just that small change has impacted pricing. And then emerging market bonds and the investment grade bond index both have sold off a little bit for a variety of reasons. But as I'll reiterate here, this is not a great start to the year. One reason why we also decided to make a little shift within our portfolios away from bonds, but in particular, long duration bonds, bonds that have a maturity greater than, call it 5 to 7 years, really don't have a place in our portfolio right now. And really the only people that would be interested in a long duration asset like a long bond would be either insurance companies that are trying to match liabilities or central banks. And I think that's probably the next step. One reason why rates are likely going to remain within this range for a period of time, because if we want to issue or bring forth the stimulus package that's being batted around within the Congress right now, some negotiations being had, particularly of the size that President Biden would like it to be, you're going to have a substantial amount of new issuance come out. And I've been a big advocate for the government issuing as long a bond as they can get away with, because that's a great way to not have any maturity risk within your portfolio on the Federal Reserve side. But we'll see what actually ends up happening. And then I would just want to make a point here that volatility has been with us for quite a bit of time. And you can see two charts. One is this is showing, consecutive number of days that the VIX or the volatility index has stayed above 20. Just recall that the average reading for the VIX or the volatility index, call it back in the mid 2010s, was somewhere in the neighborhood of 12 to 13. The average reading for the volatility index is right around 16. And here we've been above 20 for almost 200 trading days. So almost a whole year or year's worth of trading. And I think this is a good idea or good confirmation, at least in my book, that there's still quite a bit of anxiety out there among the investing community, either within the retail space or within the institutional space. And that's usually a good thing, because if there's no anxiety, that means everyone's on one side of the boat, and there's no more incremental buyers to come into the market. And I think the fact that the VIX is high tells me that there's still quite a few incremental buyers on the sideline. The good news is that if you use a longer enough time frame, once you get past these levels of the 1 and 3 month period, typically 6 months to a year after its positive returns if the VIX is this high, if that makes sense. So the fact that we're actually at these levels a number of days that the VIX has been this high, I think is a positive development. And I think that would be confirmed by some of the return data that you can see here 6 to 12 months after we get these types of extended VIX readings. So it's only one data point, nothing to really anchor to too much, but I think it just confirms some of the mosaic that we're putting together. And that is, a generally positive year for stocks. It's going to be pretty volatile, but one that really is going to favor active strategies over index strategies for sure. So now that we've talked a little bit about some of our positioning, some a bit about the markets in general, I did want to shine a spotlight on the special topic, which I think is well timed. And that is, what the heck is going on with a couple of stocks or in some of these, tertiary markets that we all seem to be glued to our seats to figuring out, the next development. And that has to do with GameStop, which is a video game retailer that was typically based in malls, AMC, which is the theater chain, and then some thoughts around risk management. So first, let's take a look at who has been involved so far in this whole saga that we'll be touching on here relating to GameStop and AMC. I think center to this whole situation has been a Reddit board. So for those that you are not familiar, Reddit is basically a modern chat board where people collaborate for ideas relating to either stock ideas or many other types of just useful or non-useful activities, cat videos, things of that nature. This Reddit board, WallStreetBets, was the source of a idea that one of their members had that said, why don't we try to create a short squeeze within the shares of GameStop. Now I'll go over to what shorting is and what a short squeeze is here in just a moment, but I just wanted to lay out some of the players here for just a minute. GameStop, I already mentioned, they're a video game retailer, typically mall-based, that is in a very big transition period. AMC is the beleaguered video or movie theater chain that, of course, because of COVID, has been just decimated. And then you've got, some of the folks that are WallStreetBets Reddit posters. A lot of them find their way onto or have Robinhood, which is a discount brokerage that's mobile based. So they make it so very easy to trade stocks. They were one of the first to bring out commissionless trading. And the way they do that, interestingly, is they sell their order flow, which means they tell people what their members are buying and selling to companies like Citadel, which is also part of this, not mentioned here, but they're a very big hedge fund and market maker that has a big role in what's going on right now. Melvin Capital is one of the biggest, a very large hedge fund, very successful. Apparently, for the last 10 years, they've been able to annualize something like 30% returns. Part of the way they do that is going long stocks, meaning they buy stocks in the hope they go up, but also shorting stocks in the case, hoping that they go down. And they were a very big short position holder in GameStop and AMC. And then, of course, the SEC is likely to play a role in this particular saga, but that's to be determined, and we'll see what actually happens as it relates to both Robinhood and a few of the other players. So let's take a look at and deconstruct what's going on here. Before we get to the actual, what is short selling, what's not, I did want to point out that since November, this is the blue line is the Goldman Sachs index of the 50 most shorted stocks and its associated performance. And this is the broad market index, Russell 3000. And this is both of these data points are through January 22nd. And some people started to notice, recently that some of the most shorted stocks had been some of the best performers over the last, few months and weeks. And you might say, well, that's a little interesting because, the prospects for some of these stocks that are heavily shorted. And by the way, people usually aren't shorting companies that have really great growth potential, good earnings potential. Usually it's because there's some change happening, some business disruption. A lot of the airlines were heavily shorted, certainly a lot of the cruise lines. And what's happening is, of course, over the last few days or months, these 50 most shorted stocks are far outperforming the broader market index. And that seems a little bit counterintuitive, because have their business prospects gotten 50% better than the market? I would argue no, but I think that this would be probably one of the first tells that something wasn't really right within the market structure. So let's take a look at, real quick before we get into that, what is short selling? So that's a key thing to understand here if we're going to talk about what's going on with AMC and GameStop and a few others now. So the definition of short selling, that's this right here on the right, this chart right here, is that first of all, if you want to short a stock, you have to borrow it from a broker. To borrow it from a broker, you actually pay interest. It's called the short interest. It's not called short; it's a short rebate, hoping that the stock goes down at a later point in the future. So you sell it short, you hope that it goes down, and then you buy shares back. And then once you buy shares back, you can deliver those shares back to the original owner. Schwab allows clients to lend their securities out to short sellers, as do a lot of other firms. Robinhood, in particular, was one that was able to lend out shares to short sellers. And that's really the definition of shorting. It's really just reversing the operation of buying a stock, buying it, hoping that it goes up, and selling it later at a higher price, right? It's just the exact opposite. But the mechanics of short selling are a bit more complicated than just buying it long, because of course you owe interest when someone lends you their shares, and then you have to, and then in this case actually, whereas if you're buying a stock long, you have a theoretically unlimited upside. If you're selling short a stock, you actually have unlimited downside, meaning that if you sell it short here, but the stock goes up, well, that's, who knows where it's going to stop. And that's really, I think, what's been at play here, amongst a few other things. So Wall Street Bets, let's turn our attention to, now that we understand who the players are and what short selling is. Wall Street Bets was instrumental, and there was one gentleman in particular that the Wall Street Journal profiled last week that really got the whole community in this David versus Goliath situation, that, as they like to call it, because the smaller investors that are in this forum here, they typically actually tend to be younger, so probably mostly under 30 by and large, apparently. But also they're very small dollar amount investors. So that's where the Robinhood becomes important to understand. And so what they said was, well, if people are borrowing shares to short them, and they're getting the short interest up to a point where it would be very difficult to buy it back at a reasonable price, why don't we just try to force the issue and create a short squeeze? And the short squeeze happens when you, as a buyer of shares in GameStop, accumulate shares and are unwilling to lend them to short sellers, or unwilling to sell them for those to cover their bets. And so that's exactly what happened. Furthermore, there was an acceleration effect here. You can see there's now 8.1 million Wall Street Bets followers. When this all kicked off in late December, early January, there was about 1 million followers, I believe, of Wall Street Bets. And so now you have, the more successful this bet with GameStop has gotten, the more people it's attracted into the space, the more people have bought GameStop. And that's really provided some rocket fuel to their trade. And you'll see that here in right now. So you can see this is a picture of GameStop. You can see this was as far back as August, September, this was about a $4 stock in August and September of this year. What happened in October was, there was a few things that created some volume. Was, in the sequence of events, I have to make sure I get this correct, but the sequence of events was they replaced their CEO, did a strategic review of their business to really try to pivot to a direct digital download model as opposed to an in-store model. And they successfully did those items. They had cash on their balance sheet that a lot of short sellers didn't believe that they had or would sustain them long enough. And starting in, again, late January is when this volume starts to pick up. You can see what happens here is that the volume starts pushing the price a little bit higher, a little bit higher. Then you start getting these really massive volume moves all on the buy side. that really shoots the stock into the stratosphere. And it goes from, $20 in early January all the way up recently. It doesn't show it here because this is a daily chart, but intraday it got up as high as, I believe, like $420. So you had a roughly 1,000% return in a month, which again is very unusual, which is why it's probably attracted a lot of attention recently. And it's really fascinating to be watching and monitoring, because these things can happen when there's very thinly traded markets. Another aspect of this, which I don't want to necessarily confuse right now either, is that a lot of the Robinhood people that were placing bets on GameStop would not only buy the stock, but they would also be buying call options. Now, call options are derivatives. One call option contract represents roughly 100 shares if you were to take it to its expiration. And what happens with options is the people that sell options to individual investors are typically institutional investors, market makers is what they call them. And they sell these options at various strike prices, typically out of the money. So starting in January, most of the only available strike prices at the time were 40, 50, and 60, maybe up to 100 or so. But then once GameStop shot through 100, that required the market makers to start buying shares of GameStop to hedge their call options that they sold to the Robinhood folks. So that provided, it's called a gamma squeeze. And again, I don't want to get too technical on this, but the dealer community also was forced to buy because of some of the, just massive accumulation of call options that were occurring around that time as well too. So this is how you go from 4 to 400 in a matter of a few weeks. It's through a short squeeze, but also, massive call option gamma squeeze as well too. The same thing, as it turned out, happened with AMC. You can see on the screen here, AMC, the movie theater company, traded as high as, this is only going back to August, but got as low as $2 in November, got back down to $2 as we came into 2021. But then they actually received, I think they were able to issue a bond back here in mid-January. And then when they got to about $6 or $7, they were able to issue stock as part of that. And that actually tided them over, apparently, that repaired their balance sheet to such a degree that there was no way that they would have been going out of business anytime soon. And that created a massive shorts squeeze, because if they are going to be solvent, then there's no necessarily reason to be short the stock. The WallStreetBets crowd piled into this name as well too, sending it all the way up to 20, bringing it back down to 9, but also kind of settling in this $13 range more recently. So just a really fascinating, example of how a short squeeze works. But also what I think is really kind of being missed here is the opportunity for those people within the Robinhood community or in the trading community to actually exhibit some risk management. Because if you go onto the WallStreetBets board, no one's recommending a sell right now. No one's recommending taking any profit. And of course, if you're the only buyers, the Robinhood crowd, in either of these stocks, then once the interest level declines, then the price will decline along with it, which is actually what's starting to happen today. GameStop is now down from its level of 225 today. I believe before I got on, it was trading at about 118. And guess what? It's probably going to go lower, because the fundamental support would suggest 30 to 40 is somewhere in that neighborhood of what it's probably worth. But I guess these two examples really change the game a little bit for short sellers. Short sellers do provide a valuable function to the market. They call out bad management teams and really scrutinize financial statements and documents to make sure that CEOs and bad actors aren't able to milk a company dry without no one noticing. And so, I guess the question is, has the game changed for short sellers? I think it's a very difficult time to be a short seller right now. And a number of prominent short selling firms have actually closed up shop as a result of GameStop, one of them being Citron. Most recently indicated they were only going to be identifying long ideas as opposed to short ideas. And you can see it, here in that the median percentage short of the S&P 500 is now declined all the way down to about 1.5%, which is right around what it was post 2000. So I think short selling as an activity is really gotten a lot more difficult, particularly if you can, if you're vulnerable to short squeezes like some small cap stocks certainly are. And I think, this strategy as a viable option, particularly within our portfolios, probably needs to be rethought. We don't have any exposure really to a short dedicated strategy. We do have some long short strategies that are long biased, but I think one of the key lessons here, of course, is to try to identify if you get massive upside that you weren't expecting, that if you can't figure out why a stock got to where it was with a lot of analysis, then you're better off taking some profit and moving to other opportunities. So here are just a few of the key takeaways before we wrap it up. I know I've gone a little bit long, so thank you for humoring me a little bit. It was just such a great topic. I couldn't help myself. Equity market structure isn't necessarily changing. This has been some of the Pollyanna calls from Bloomberg and other news outlets to say, well, the market structure has changed, and we need to be all prepared for that. I don't think the market structure itself has been changed. It's just the participants have changed a little bit. And particularly if you can crowdsource things like a short squeeze, then you have to be willing to be on the lookout for those types of activities if you're going to play in this as a short seller. So new participants are actually forcing a different perspective on short selling in particular, but also, something that we could probably pay attention to is what's being talked about on some of these popular stock chat boards to see if we have any positions that are being mentioned that might be being pushed to levels that don't make a lot of sense. That's kind of one takeaway, I think, for us. Situations like GameStop, this is the symbol for GameStop, and AMC can seemingly come out of nowhere, and we've got to be ready to act when unique opportunities are presented. So having cash equivalents and or non-correlated positions that provide some flexibility is really critical, because if you're not ready to act, then it's going to be really difficult to act in the heat of the moment. And I think that's just a key takeaway that we've been a big proponent of for quite some time. And then, of course, I think, as we do have option strategies. We do have some hedging strategies available to clients. And I think it just speaks to those competencies that if you don't understand the tools that are in the toolkit, particularly the options market and their impact on stock prices, then you're really missing a key piece of the mosaic that can help bring some clarity to a seemingly, confusing situation. Especially now that options are becoming a lot more available to the individual or retail investor. I think this definitely has implications, and we'll certainly be trying to figure out ways where we can benefit from, these types of knowledge bases or knowledge sets. So with that, I'm going to call it there. I've gone a little bit over, about 7 or 8 minutes over my indicated time frame, but I'll pause it here. If you do have any questions or comments, please feel free to lob those into the chat feature. If it's something that I can answer, I'll answer right now. And if it's not, I'll just make sure to get back to you here as soon as I can. So I'll pause it for some questions and see if anything comes up. And if not, we'll call it after that. So let me just give it a moment here. Oh, one thing I forgot to mention about the whole Robinhood situation is that because the losses were so great within that Melvin hedge fund, losses were thought to be up to $3 billion. We learned later that was actually just the first piece of it. The structure of them, or the online broker Robinhood, also needed to accept capital because of to maintain stability on their platform. Now, this is also one reason why we don't necessarily like to engage with startup technology providers, because they may not have the resources to weather situations that are stressful. So needless to say, Schwab and or Fidelity or TD Ameritrade, none of them experienced any problems in handling any trade flow or balance sheet issues requiring any additional capital, because they tend to be a little bit more conservative investors and are well capitalized, supporting that function of their business. Okay, well, it looks like there aren't any questions in the queue, so I do want to thank you for your time today. very much appreciated. I'm hoping we can get our epidemiologist friend on for next Market Matters. But in the meantime, have a great rest of your afternoon. We look forward to seeing you soon sometime in March. Take care.